Hello class, here's some narrated PowerPoint slides that explain our accounting for deferred income taxes. You should also read the written explanation as well. So this kind of goes along with it. So together, this should help you see how we need to look at deferred income taxes. So first of all, we want to talk about the concept of permanent differences. All of the issues with regard to the income taxes as far as accounting arise because the tax law is different than U.S. GAAP. So the rules about how you record income and expenses under GAAP for our income statement, and the rules for which you apply revenue and expenses to your income tax return are different. IRS and Congress set the rules for taxes, and FASB sets the rules for GAAP. So there's a lot of differences between the two, and therefore we have to account for those. First type of difference is permanent differences. These are items that will never be taxable or deductible, meaning they will never show up on the incomes on the tax return, even though they show up on the financial statements. For instance, life insurance. If you buy life insurance on your officers, which is a very common thing for companies to buy a life insurance policy on their executives, the tax law reads that life insurance premiums are never deductible. Not today, not ever. So that would never be an expense on your tax return, but it would be an expense on your income statement. And then when you executive dies and the life insurance pays off, you would not count that as income on your tax return, but you would on your income statement. So that's a permanent difference. Municipal interest is another example. There's not a huge number as far as that we want to talk about, as long as you understand the concept. What they do is they change the effective rate. So in the United States, the current effective rate for 2018 is 21%, flat rate. It was 35% in past years in 2017 and before, but is now 21%. So if there is an item that is not going to affect your tax return, then when you calculate your taxes at 21% of what's on your tax return, it's going to be different than 21% or your effective rate on your income statement. So that's why it changes the effective tax rate. And we need to disclose those major permanent differences in the footnotes as a reconciliation to show why we are not paying taxes at the same rate as the enacted rate, which or the regular rate of tax. Now, the more complicated and more, perhaps you might say, frustrating are the temporary differences, because these actually have to be accounted for with journal entries, unlike your permanent differences. They affect net income and taxable income in different periods. So something may be included on the income statement this year in 2018, and then on the tax return in 2019, or vice versa. So those are what we refer to as temporary differences. So future deductible amounts are items that are currently on our income statement, but will be deductible in the future, meaning they will reduce our taxable income in the future. That is a deferred tax asset, because your taxes in the future will be lower because of what you did this year. So that's what we mean by a deferred tax asset, is an item that is going to cause your taxes to be less in the future. A couple of examples of that, any estimated expenses like bad debts. We estimate our allowance for bad debts, we estimate warranties, we estimate the write-off on our inventory for lower of cost or market. Anytime we estimate that, None of those are acceptable for tax purposes. You tell the IRS that you're estimating the expense, and they say, too bad. So we record it on the income statement, but we can't put it on the tax return until it actually happens. So for instance, on warranties, you estimate your warranty in 2018, put it on the income statement, but you do not record that as an expense on the tax return, future deductible amount, until you actually fix the item, which may be 2019, 2020, sometime in the future. Unearned revenue works a little bit just the same way, but backwards, in that the tax law says that when you get unearned revenue, so if someone pays you for something you haven't done yet, you actually have to report it on your tax return, even though according to GAAP it is not earned, and you would not put it on your income statement until later. So that's a future reduction to your tax, because you'll have already paid tax on it when you receive the income, not when you earn it. Future taxable amount works the other way. These are things that are deductible on the tax return, but not on your income statement yet. These result in deferred tax liabilities, because in the future you'll have to pay increase in taxes because of the current events in the current year. Usually the biggest example of this is accelerated depreciation. The tax law allows for all kinds of special depreciation deductions, bonus, accelerated, makers, all of that, in order to incentivize businesses to buy more equipment. Well, for income statement purposes, we're not interested in incentivizing. We're interested in measuring the actual use of that asset. And so we usually use straight line. So we have extra depreciation on the incomes on the tax return, and it will not be deductible on the income statement until later, as you do it on a straight line. The nice thing and the positive thing, I guess from a standpoint of complexity, is despite the fact that some of these will be several years in the future, that they will what we call reverse, meaning you'll be deducting them in the 5 years down the road, we do not have to worry about present value. The FASB has allowed there to be this long-term liability or asset that does not need to be calculated at present value. So how do we account for this? The focus is on the balance sheet. You want to make sure your asset or liability is correct. So you're looking at the total difference to date between the, say, accumulated depreciation on your tax return and the accumulated depreciation on your income on your balance sheet, and you're comparing those two, figuring out the difference, and then multiplying it by the current tax rate. So you're looking at the rate that's been enacted. So for 2018, the enacted rate is 21%, not the 35%. There was a change, meaning that every asset and liability having to do with taxes needs to be adjusted in 2018 to the 21%, because that's what is going to, that future benefit or future taxable amount is going to be at 21, not 35. They are deferred tax assets and liabilities are classified as long-term, regardless of what the items they have to do with. So FASB simplified this for years going forward, and everything is long-term. There will be no more current deferred tax assets or liabilities. Tax assets must be evaluated. One of the things about a tax asset is the only way you're going to get a benefit from a future deductible amount is if you have income in the future. So having a deduction with no income doesn't do anybody any good. So that means that you have to look at your tax assets and evaluate them on an annual basis to make sure that you're going to be able to use them to offset future income. If that's not the case, then you need to create an allowance, meaning basically what you're admitting is that some of these assets will never be realized. You'll never get a benefit from that future taxable, future deductible amount, because you're not going to have enough income to utilize it. And that's what an allowance means. When you create an allowance, you create credit allowance and debit tax expense, just like if when you deal with the allowance or increasing allowance for bad debts, and credit the allowance and debit bad debt expense. Unfortunately, companies can use it to smooth earnings. It's a judgment call, and so there's a lot of judgment involved in whether or not you're going to be able to use those tax assets. The new tax law actually makes it more likely, because things like carry forwards can be forever, and therefore there's less likelihood that you will run out of benefit in the future for some of your tax deductible amounts. Now, one of the things that especially interesting in the tax law is net operating losses. Now, net operating losses changed with the new tax law in 2018. Prior to 2018, if you lost money as a corporation in a current year, you could carry that loss back and offset some of your income from past years. So you would go back 2 years and forward 20. It was two back, 20 forward. So if you took it back, you would actually get a refund of money you had paid in the past. So for instance, if you had $10 of income the last 2 years, and then you had a $30 loss in the current year, you would take that back and offset the 10, get a refund for the 2 years ago, and then offset the income from 1 year ago and get a refund for the tax you paid for that year. So that would wipe out all of your taxable income for the last 2 years, and you'd still have some loss left over to go forward. But that's how you would do it. You would create a refund receivable for making, for the money you're going to get back, and the part going forward would be a deferred tax asset with a likely valuation allowance, because you just lost a lot of money. Now, under the change in the law, you now do not go back. You go only forward, but you go forward forever. So there's no 20-year limit. So that is there will be no, once we get through with people handling 2017, there will be no refund receivable. So 2017 will be the last year you can carry back a loss. So there will not be any refunds. You will only have the deferred tax asset going forward. What do you have to put on your financial statements? You need to put some footnote disclosure. GAAP says you must reconcile your effective rate to the statutory rate. So what did you actually pay? The effective rate is the amount of taxes divided by your income before taxes. That's your effective rate. The statutory rate now is 35% of 2017, 21% for 2018. Okay, you must describe major causes of deferred tax assets and liabilities. Basically your big temporary differences. Any change you made to the valuation allowance because of the smoothing we talked about earlier, this judgment call. If you made a judgment that you had to change your valuation allowance, you need to describe why in the footnotes. And then there's the last piece, is the biggest catch-all: uncertain tax positions. In the tax world, everybody knows that there is a constant need for estimating. When you file your tax return, it's an estimate of what you look at. And every company is basically under an obligation to shareholders to take the most advantageous position on certain items, whether they be deductible or income or whatever, as they can for their shareholders, which means that at some point IRS is going to say no. But we don't know where that is. So we take uncertain tax positions, we figure out a percentage likelihood that we will win, and we create a kind of a offset to indicate that we understand that some of these things will come back and we'll lose with the IRS. And I'll tell you that most big companies are in a constant audit. It is not a matter of if, it is a matter of when they get audited. They are usually being audited multiple years, usually as many as 8 to 10 years are being audited at any given time, and they're in a state of negotiation on multiple things back and forth between them and the IRS till they finally come to some conclusion and get it established. So then your uncertain tax position would be no longer uncertain. So that's a little more advanced idea that we won't spend a lot more time on other than understanding that there's disclosure about that.